How do we think of the portfolio construction today? Like I said, we are deviating significantly from Nifty, right? So I need to explain why are we doing this? We're not doing this because we want to be different. We're doing this because for the first time, after a long time, we're seeing structural changes. So I'm just going to combine four graphs in order to paint the thesis around how we are thinking about this cycle. First, obviously, the private sector sanctions by banks has increased in a significant way, which is your proxy for credit growth. So what you actually saw in calendar year 23 was non-linear growth in public capex. Going into calendar year 24, as you go into elections, it's our belief that you're going to see a renormalization of public capex, but private capex taking over. And hence, loan book growth should not slow down. Second, on the real estate side, inventory levels are at its lowest ever that we've seen in the last 11 years, as a result of which you see new supply picking up and getting absorbed in the system significantly across geographies. We've seen this cycle before where developers, India is one very unique country where no developer has ever expanded beyond its home turf. They have tried, every developer being the largest have their home turf, but no one has expanded beyond their home turf. They tried in the previous cycle, it failed, they had to scale back. Again, now we are they're trying to do this again. We'll see whether this works out. It's not going to be easy though. Third, in terms of the core sector facing economies, economy facing sectors, you're talking about cement and steel. You still don't have oversupply. There is a deficit, as a result of which there continues to be a net deficit on the power side as well. And fourth, put together all of this, how do we think about companies, and why do I say private capex is going to come in a slightly more aggressive way in calendar year 24? Because balance sheets are not levered. Most of your growth that I just showed you, where 56% 3-year growth has actually translated into real cash flows this time. As a result of which, your reinvestment is not coming from re-levering your balance sheet. It is coming predominantly from cash flow generation. And hence, when companies take up debt, they're doing it with much healthier balance sheets. And this is across sectors, be it hospitals, be it hotels, be it travel and tourism, be it iron, steel, be it commodity-facing sectors like metals, etc. So thought process is what I just summarized. I do expect private capex picking up steam post-general elections. A lot of interesting themes in the import substitution, project announcements, and cap goods should continue to maintain positive momentum. All of this would result in credit growth. And one of the things that you need to monitor, which is at least something that we are monitoring, is small ticket personal loans are picking up in terms of slightly higher delinquency. So you might hear noises from RBI. RBI does act ahead of the curve versus many other central banks. So are borrowers taking small ticket personal loans to fund EMIs of other loans? It's not a healthy sign, but you are going to see that in this cycle. This will not manifest into, this is very, very, very early stages of a credit cycle growth, but this is something that one needs to keep a trend on, because the 30 plus delinquencies, which is basically how long it takes to pay your loans, especially in the sub 50K segment, which is your microfinance segment, is picking up. Again, this is not something as a concern, but this is something to flag as well, because end of the day, just because you get growth doesn't mean everything is rosy either. What do we think about 2024 in terms of how we view the market today? I think US as a geography continues to offer least risk reward. We said that in 23, it was wrong. 24, we continue to believe the same thing. EM should continue to outperform. I think that's the cycle that we are in. India equities, this is our belief. This should be a very good year to construct portfolios for next year and the following year's returns. That's how we think about it. We could certainly be wrong from how we think about a base case, but us building higher than normal cash balances in portfolios, taking longer time to deploy, is a consequence of what we believe as we speak. Many people believe that we are going into a rate cut cycle. I don't think so. I think if the Fed actually cuts rates, I think it's a big mistake. I think it's going to be politically influenced because you're going into October and November elections. They might want to show a strong economy in order to get into the elections. That could be a reason for them to cut rates. But I continue to maintain that we are in a higher than normal inflationary cycle. And I think in the next 4 to 6 quarters, you are going to see 10 years touching 5%. It is a counter consensus call, but that's where I think we are getting to. The only way Fed can delever its balance sheet is inflating its debt. Commodities to do well. I think commodities will do well in this cycle, including the likes of uranium, where alternate sources of power are getting explored. China is investing significantly in nuclear, and uranium is the raw material for that. You're going to continue to see that trend. And this is more of something that just to watch out for. Gold, while gold should do well in this cycle, it's important to just see because in the previous cycle, while I don't have a view on Bitcoin, but at the same time, they're talking about ETFs getting launched. ETFs getting launched means democratization of Bitcoin. It means my and your grandmom can actually buy Bitcoin as well as an ETF, which they could not because they had to own a private key, they had to own a wallet. It was technologically slightly more complex. It was not open to all. This opens it to everyone. So from an adoption perspective, it can become extremely broad-based, and that has larger ramifications from a liquidity and adoption perspective, it getting more retailized as we speak. So it's an interesting trend to watch out for in 2024.